He kōna I purangi tēnei nā te reo irirangi o Aotearoa.
Could the government take away the option of withdrawing money from KiwiSaver for a first home? What's the best way to cope with falling share markets? And are we definitely going to be able to access our KiwiSaver money when we're 65? Those are some of the questions we're answering on this episode of No Stupid Questions. It's our 25th episode and a KiwiSaver bonanza. I'm joined by Justin Gregory.
How you doing? I'm here to ask all your questions, to delve into the KiwiSaver data, to reveal KiwiSaver returns or, something like that.
We've settled on a KiwiSaver episode because not only is this our 25th episode, which is obviously very important, but also we're releasing it on April the 1st, the day on which the government likes to change things.
All sorts of things. Benefit rates, ACC levies, minimum wage.
And this year, KiwiSaver contributions. From Wednesday, default contribution rates lift from 3% plus 3% to 3.5% plus 3.5%. As well as that, people who are 16 and 17 will start getting employer and government contributions. It's the most interesting KiwiSaver change we've had in a while, so it's good to mark it.
Okay, getting into it. Our first question is from Sue, who wants to know, how likely do you think it is for any government to remove the option of withdrawing KiwiSaver money to buy a first home? Ooh, spicy.
Yeah, this is a question that will strike fear into the heart of many people desperately saving for a first home.
Mm-hmm.
As you know, you can pull your money out of KiwiSaver to buy a first home when you've been in the scheme long enough, and thousands of people do it every month. I talked to Dean Anderson, who is founder of Kernel, about the question.
It's possible, but unlikely. I think it's become so ingrained now. And if we look at house price affordability in terms of deposit size and also the mortgage servicing to income ratios, I think KiwiSaver has become actually a key tool to actually help Kiwis into their first home. So, I just think because of the role that it now plays, it's highly unlikely any sort of government party would sort of remove that lever. While I kind of actually sympathise with it, and I think if you actually look at the problem here, the use of KiwiSaver, and same in Australia with superannuation, in one lens could actually be fueling the house prices. So, it helps keep house price pressure up. There's an argument that could be made would be net better off if we didn't. But I think the emotive element and the passion that comes with Kiwis wanting to own a home would be very hard politically to pull that out.
Too hot for politicians to touch, huh?
I think that probably is the case. I know there has been some discussion of how the rules might need tweaking if we ever got to the point where the scheme was compulsory and maybe the pension was being means tested. But I think the first home withdrawal option would be fairly safe, and that's probably a long way down the track anyway. And owning your own home is a really helpful thing for retirement.
Now, one from Deb, who says, we are 70 plus and still pay into our KiwiSaver from part-time work. Should we transfer most of our money to a bank until the Middle East conflict settles down? Susan?
I wouldn't. I hope Deb is already in a relatively conservative investment if she needs the money soon anyway, so it shouldn't be experiencing the same drops as my growth fund, for example.
Or my growth fund, yeah.
Yes, I looked at that before I talked about KiwiSaver recently, and I deeply regret it. Yes. If you're investing in a less conservative fund because you have longer, then stick with your strategy. I talked to John Berry at Pathfinder about this.
If you're concerned around markets coming off because of conflict, it may actually be you're in the wrong fund, you're in the wrong risk profile fund. And, some KiwiSaver providers, most will offer conservative balanced and growth. Some even offer a cash fund. So if you're super concerned and you're low risk, you've got low tolerance for risk, a short time horizon, you might need the money in a month's time or 3 months' time, then maybe even a cash KiwiSaver fund is the right place for you. But it's, their question is almost framed of, shall I move out of KiwiSaver into cash while the conflict's going on and then move back again when the conflict's over? And the answer is absolutely not. Like, you shouldn't be trying to time the market like that. You should just be in the right risk profile fund, the right strategy, and stick with that. So, and the example I like to use with people is COVID, March 2020, when the US market fell by 33%. And a lot of people were uneasy and switched, but then the market, within just over 6 months, the market was back to where it started, and those people have moved to cash, and suddenly they missed the bounce when it came back up, and essentially they lost that return, whereas they should be in a fund they're comfortable with and just stay with that.
Next up, one from Katie, who says, I think my KiwiSaver isn't the best one for me. It has high fees, and I prefer more focus on ethical investing. But now the market has fallen. If I move to a new one at this time, won't I just seal in that drop in value? Is there a best time in terms of market to change KiwiSaver?
Katie has taken the message from John on board to too great an extent, I think. I've heard people involved in KiwiSaver say that all sorts of activity slows down when markets are weak, which is great if it means people aren't panicking. But it's not so good if it means they've kind of been immobilised because they don't know what they're meant to do and they know that they aren't meant to switch out of fear. So I talked to Rupert Carlyon at Kora about what people should do.
The short answer is, can she move her KiwiSaver now? Yes. Average KiwiSaver fund is actually only down about 3-4% since the start of the Iran war. So there hasn't been a huge move because markets haven't reacted yet. I think the press and what we're seeing in the media and from politicians is far stronger than what we are seeing from markets. Yeah. So that's point one. Point two, even if markets had fallen significantly, could she move? Yes. As long as she is moving to something that is of a similar risk nature or more aggressive, then she's not going to miss out on the recovery when it happens.
Yeah, that's true. So as long as you're not going more conservative.
Exactly. So if she kind of goes from a growth fund to a growth fund, she's basically moving one set of global shares to another set of global shares, and it's going to be more or less the same. If she goes from a growth to an aggressive, then actually she's buying into the new world at a slightly cheaper rate, and so therefore will benefit more so from the recovery. It's just moving now to a conservative is difficult. In saying that though, if she is moving to a conservative fund because she's about to buy a house or for the right reasons, now is the time to do it, because who knows what's happening next.
All right, quick fire one now. Fred and Bev. What a classic pair of names, Fred and Bev. Fred and Bev want to know, why do workers over 65 still not get paid KiwiSaver contributions by some employers?
Yeah, I've heard a bit of frustration around this with the introduction of contributions for people under 18. People who turn 65 feel like they're missing out if they're still doing the same job, but now their employer gets to stop contributing to their KiwiSaver account. I spoke to Massey University banking expert Claire Matthews, who's very sympathetic.
Well, the argument is, and let me be clear that I don't agree with the argument, but the argument is that because you're over 65, in almost all cases, you will be receiving New Zealand super, and therefore you don't need, and it's not right that it's kind of seen as a form of double dipping. Now, I firmly disagree with that view. I understand why the government contributions stop, because the government is contributing to your income via New Zealand super, so they don't need to contribute to your super savings anymore. But I absolutely agree that if you're in an employment situation and you're continuing to work, that if your employer is not contributing to KiwiSaver for you, then they're effectively making you take a pay cut unless they are topping up your income to reflect the fact that they're not making those contributions.
But at the moment, I suppose it's just the way the rules are and we have to live with it?
Basically, it is. The rules are that the employers have the option. And for some of the employers, it's seen as a way of saving some money, because in most cases, they're not topping it up. They're just stopping the contributions. So you can continue to make your contributions, but the employer stops, and effectively it saves them money unless they do top you up. But in most cases, the reason for not doing the employer contribution is because it saves money, so they're not going to.
Okay, now, Tim wants to know what he should do with $10,000 he has to invest for more than 10 years. He says, should he be looking at a company like Simplicity, which has very low fees, or something like Milford Active Growth, which has been a very good performer? So what's going to be better in the long run? Low fees or higher returns?
Yeah, I went and spoke to Edward Glennie about this. He's a financial advisor with Genesis Advice. He says it's about finding a manager whose philosophy feels right for you.
So you can pay as low as you want, but what are you going to get on the other side in terms of your net return? And I think that's the thing with the active growth fund. Their philosophy is really around markets are very dynamic, a state of constant change. They use that terminology, and that they use an active portfolio management approach, which means they're using, they've got a team of analysts and and research teams that actually go and investigate what's a good investment. Whereas a passive approach that simplicity entails is essentially just buying the market. Both have very strong ESG requirements, which means that they're invested responsibly. But it really, to me, boils around, do you think that they can, through their active management approach, continue to deliver returns that they have done since the inception of that fund? Or do you think that's not possible and you just want to track the market? Then you really want to focus on the net return. And there are websites that you can use. Sorted website is pretty good to see what the difference is based on the historical returns, but also that's a very fundamental point in investing. Past performance is not a guarantee of future returns, Susan, as I'm sure you've often said to your listeners.
You'll also hear from people who argue strongly that fees are the most important thing because it's so hard for fund managers to consistently outperform markets. But it all comes down to what feels like a good fit for each investor.
Greg has a question. He says, as I understand it, the age of entitlement to access our KiwiSaver funds is linked to that at which we receive national superannuation, currently 65 years old. With consideration occasionally being given by politicians of all hues and persuasions to increasing the age to receive national superannuation, says Greg, would that also mean the age of eligibility to KiwiSaver funds would also increase? Ooh, niggly question. Nice one, Greg.
Yeah, at the moment, yes. The way KiwiSaver is structured, our ability to access it is tied to the age at which we're eligible for the pension. So that's 65, but it might not be 65 by the time you and I are 65. Fraser Winneray, whom you might remember as former chief executive of Mercury Energy, is actually campaigning at the moment for KiwiSaver changes, and this is one of the things that he wants to address.
Yeah, so that's the D-link, which I want in KiwiSaver 2.0, that the access to KiwiSaver, which is someone's own money, needs to be its own specified date, which I'm proposing is no later than 65. So therefore, even if NZ super ages do shift, people for their own financial planning do want to know that they can get hold of their KiwiSaver at 65. So it shouldn't be linked.
Yeah. Do you think people might be surprised to know that at the moment, if the age went up, the access might change?
I'm willing to bet 99% of New Zealanders think it's fixed at 65. It has been a surprise to everyone I've spoken to. So it should be 65, no later than 65, because people are doing their own financial planning, you know. It is their money. I mean, it's like someone saying, I'm going to tell you when you can get your money out of the bank account, when you've all agreed it was going to be 65.
I just want to come off the back of Fraser for a second there. Is this something that was always baked into KiwiSaver from the start? No one's tinkered with it since then and added this clause?
No, it's just the way it's written that you can access your KiwiSaver when you're eligible for the pension. And so that does mean that at the moment it could move.
This week, Susan, I saw you talk to Reserve Bank Chief Economist Paul Conway, friend of the show, I believe, who said, we're not imagining things, it is expensive here. I'm sorry, I want to follow this with an enormous duh, but so I'm going to. Duh! Not you, Paul Conway, everybody. We're not imagining it, it is expensive here, says Paul Conway, Reserve Bank Chief Economist. Susan, go.
Yes, it's very expensive. He says rates, insurance and gas have jumped particularly in price in recent years, which probably also no surprise to anyone. Tobacco products are among the most expensive in the OECD because of our excise tax. And milk, cheese, eggs and fruit are also well above the average, which seems unfair given how much of some of that stuff we produce. But seafood, clothing and meat are slightly below average. He says the problem for lots of households is our spending power. Again, probably no news there to anyone. Before 2020, the purchasing power of wages in New Zealand was growing faster than the OECD average on the back of strong employment growth, favourable terms of trade, all that good stuff. But now it's about 20% below the countries we normally compare ourselves to.
All right, so that's the problem. What's the solution to the problem?
I think we've got the trifecta of stuff we know. It's New Zealand's perennial solution, improving our productivity.
Oh, yeah.
He says that needs to happen so that we can have a stronger economy and the Reserve Bank doesn't have to be so dramatic about its interest rate decisions to stabilise our inflation shocks. But improving productivity has been tough. He says we need policy settings that build resilience into the structure of the economy by encouraging flexibility, investment, adaptation. It sounds good, but now we've got to make it happen.
Last week, we asked you about carless days and I told you a fascinating story about my lovely Auntie Helen and her little ripper car. But anyway, when did we try this in New Zealand and did it work?
So carless days were a thing between July 30, 1979 and May 12, 1980. As for did they work, I gather no. People came up with ways around it so that there was only a small drop in petrol use.
Yep, don't underestimate people's ability to find ways around rules. Especially Kiwis, we're great at it.
This week we want to know which year was New Zealand's first attempt at a major superannuation scheme introduced.
Imagine what those balances could be from then. Crikey.
Send your answers as well as any questions you might have to questions@rnz.co.nz. No Stupid Questions with Susan Edmunds was written and presented by Susan Edmunds. That's me. Justin Gregory is the producer. The engineer is William Saunders. Thanks to Sue, Deb, Katie, Fred and Bev, Tim and Greg for their questions, and Dean Anderson, John Berry, Rupert Carlyon, Claire Matthews, Edward Glennie and Fraser Winneray for their answers. Follow and listen to No Stupid Questions with Susan Edmunds on Apple Podcasts, Spotify or any podcast app so you don't miss an episode. Stay safe, everyone.